Welcome to The Explainer. Today, we're going to break down a really fascinating risk model from the world of fintech. And what's so cool about it is that it borrows its logic not from economics, but from straight-up industrial engineering.
All right, so take a look at this. I know it might seem a little complex at first, but the core idea is actually super simple, and it comes right out of industrial engineering. Just imagine a high-pressure pump house, right? When the pressure gets way too high to dangerous levels, a valve, just like this one, automatically pops open to release it. It's a purely mechanical safeguard. There's no emotion, no hesitation. It's just a system built to prevent a total disaster.
So, that leads to this really powerful question. What if your financial capital had that exact same mechanical safeguard? I mean, that's the whole idea behind the pressure valve risk model. It's all about taking these proven industrial safety standards and applying them to financial risk. Basically, taking the unpredictable human emotion out of these huge decisions. Okay, but before we get into the nuts and bolts of the solution, we've got to really understand the fundamental problem it's trying to solve. And that is this constant battle between our own emotional reactions and the cold, hard mechanics of the market.
I mean, think about it. On one side, you've got this industrial system where safety is totally mechanical, it's automatic, it's forced. And on the other side, you've got us, the human trader. When the market gets volatile and that pressure starts building, our response isn't mechanical at all. It's completely emotional. We start trading forced releases for things like hope and guesswork. And instead of preventing failure, well, we pretty much just invite it in.
So the big question is, how do you actually engineer safety into trading? Well, this model says we should just stop trying to fight our emotions. It's a losing battle, right? Instead, we should build a system that just bypasses them altogether. The whole point is to replace all that human guesswork with a framework that's built on the same kind of logic you'd find in a factory, like preventative maintenance.
Okay, so let's get into the good stuff. How is this digital valve actually built? It's a really elegant end-to-end architecture, and we can break it down into three distinct parts. First up, you've got the core engineering logic. This is basically the brain of the whole operation, defining all the safety boundaries before you even start trading. Then you have the user interface, which is all about making those boundaries super clear and easy to see. And finally, there's the system integration. This is the muscle, the part that actually enforces the rules automatically. So, the engineering logic, it all starts by setting up what's called a safe execution zone. The best way to think about it is like a plant engineer who says, hey, this machine can't operate above a certain temperature. It's the same idea. The system uses data from before the market even opens, we call that pre-market data, to predict a likely trading range for those first few chaotic minutes. Any price movement that happens outside this preset zone, the system just treats it as system overload.
And this is where the UX comes in. It takes all that abstract data and makes it totally concrete, something you can understand in a split second. It literally visualizes the zone by putting a clear overlay right on your trading chart. That way, you know instantly whether you're in a safe spot or a dangerous one.
And this is where the engineering part gets really, really cool. This slide shows the system's force feedback design. See that gray zone? That's the super volatile opening range, and it's marked no trade. But here's the kicker. It's not just a warning. The system actually disables the buy and sell buttons when the price is in there. It makes it physically impossible for you to make an emotional mistake during those critical, high-pressure moments. And finally, you've got the system integration, which pretty much acts as the gatekeeper. It's constantly checking one very simple thing, using simple if-then logic. If the price is inside that high-pressure danger zone, then all trading signals are completely blocked. Simple, effective, and totally automatic. It's that final layer of protection. Okay, so that's the theory, that's the architecture. But does it actually work? Let's take a look at the proof and see how this system performs in a real, live, and totally unpredictable market. All right, check this out. On the left, you're looking at the NDX index right when the market opens. See that? It's just wild swings, no clear direction, pure chaos. And the system, it does its job perfectly. It blocks all trades inside that gray zone. But now, look to the right a little later in the day. The price action has calmed down, a clear trend is starting to form, and now the system says, okay, it's safe to engage. And it's not a fluke. We see the exact same principle at work right here with the stock WPM.
The system isn't trying to guess which way things will go during that initial chaotic period. Nope. It just waits patiently until a clear, executable trend has actually formed. I mean, this is what discipline by design really looks like in practice.
And all of this brings us to what might be the most powerful takeaway from this entire model. It's really a fundamental shift in how we even think about managing risk.
And this quote really says it all. We don't manage risk by guessing, we manage it by engineering. This is the absolute key. The whole model is about this fundamental shift, right? Risk management stops being this subjective, emotional thing. It becomes an objective, engineered process. You're not relying on your gut or reacting to fear anymore. You're just following a predefined mechanical set of rules.
So, by defining these safe zones before the trading session even kicks off, the system is essentially installing that digital pressure valve. It's a proactive, mechanical safeguard that's designed for one single purpose: to protect your capital from that explosive and, let's be honest, often destructive volatility of the market open. And that leaves us with one final and, I think, pretty provocative question. In a world that's more and more driven by data and automation, is this the future of financial discipline? Could systematically engineering emotion out of our most high-stakes decisions be the ultimate key to long-term consistency and success?